All right, it's all yours.
So we're going to call this meeting of the State Investment Council to order. Going to start with asking Andy to please call the roll and establish whether or not we have a quorum. Thank you.
Good morning. Governor Lujan Grisham. Commissioner Garcia Richard.
I'm here.
Secretary Romero. Secretary Romero? Okay. Treasurer Eichenberg.
Present.
Mr. Lavender.
I'm here.
Mr. Rawson.
Present.
Mr. Jennings.
Present.
Mr. Messina. Mr. Tejas.
Here.
Miss Allen.
Here.
Mr. Bingaman.
Present.
Madam Chair, we have a quorum.
Thank you, Andy, and good morning, council members. I believe the chairperson, the governor, is actually in Glasgow at the climate conference. That's the reason I'm here. Not entirely sure, but that's what that's what I believe. So we're going to go on to agenda item 1B, which is approval of the agenda before the council. If I have a motion for approval.
It's Harold. So move.
You have a second on that? Thank you, Harold. Okay, there's no second.
Second.
All right,
I'm sorry, who was?
Approve the agenda by Member Lavender. I think that was second by Member Tejas. Is there any discussion on a motion to approve today's agenda? And we will be taking all of our voting items as roll call votes today because we are meeting telephonically. So, Andy, if I could have you call roll on a motion to approve today's agenda.
Commissioner Garcia Richard.
Yes.
Secretary Romero join the call?
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Has Mr. Messina joined the call? Okay. Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Motion passes, Madam Chair.
Okay. Let's go on to
9-1.
Thank you. 9-1. Thank you. Let's go on to agenda item 1C, which is approval of the SIC minutes from our September meeting. I hope everyone had a chance to go over those. I'm not sure if there's any changes or questions on those, but I will take a motion to approve the minutes from September's meeting.
It's Harold. I move approval.
This is Kathy. I second it.
All right. We've got a motion from Member Lavender to approve the minutes and a motion second from Member Allen. Is there any discussion on that motion? All right. Being none, we'll have Andy call roll on the motion to approve the September minutes.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the minutes are approved unanimously, and I misspoke previously on the prior motion. Mr. Messina is not on the call, so that was also approved unanimously on the agenda.
Thank you very much. We're going to go to agenda item 2A and hear a briefing from our State Investment Officer, Mr. Moise.
Thank you, Commissioner. Good morning, everyone. If you'll please refer to item A on the SIO briefing for October. We'll take a look at NAV distributions, oil and gas prices, etc. And I realize that some of the comparisons I'm about to give you date-wise are not exact, but they're the closest comps that are available, and they do definitely tell a story. As of September, total distributions for the last 12 months have been $1,091 million. The net asset value as of last Friday was a new intra-month high, $35,595,277,198. West Texas Intermediate, as of last Friday, was at $83.76. The New Mexico Intermediate price was $80.31. But I think we should note that as of yesterday, WTI hit $85.07 per barrel intraday, and that topped $85 for the first time in 7 years. It's down a bit today, but that is worth noting. In terms of rig count in New Mexico, in October 23rd of last year, we had 45 rigs operating. As of last Friday, we had 87, from 45 to 87. And now we'll talk about natural gas. These are the most current comparables we have available. As of July 30th of this year, U.S. natural gas prices were at $4.73 per MCF. The New Mexico price was $5.03 per MCF. Natural gas prices have dropped about 16% since they hit a 13-year high of $6.31 earlier this month. Any questions on any of those items before I move on?
Steve, just along these same issues, in Texas, in Lubbock, one of my friends was there Sunday, and he went to 3 gas stations before he could find gasoline. And I don't know why or what, but that, they were just, every place in Lubbock was really out of gas. They had diesel, but they had no gasoline. So there's some real supply problems somewhere that could only make those prices price of gasoline and stuff go up, I would think. Just whatever that's worth. Thank you.
Interesting to hear, Tim. Thank you. If I may ask you to focus on paragraph B, investment matters, on my briefing. We'll look at net asset value. I want to point out just a few things in particular on each of these items. Our net asset values have grown over the last 11 years by $21.1 billion. That is remarkable, due to a lot of different factors. We can go into those if you wish, but let me go on to distributions for just a moment. Item 3 under paragraph B, and let's emphasize 4 things here. First of all, the multi-year growth in distributions, which I think is remarkable, is really what's important about what we do. What do we distribute? So in fiscal year 11, we were at $720 million. FY22, $1.15 billion. We're estimating $1.154 billion in distributions for FY22. That's an $84 million year-over-year growth. Important numbers to keep in mind. Under investment performance, item B and B5, if you will, We don't have this number on here, but I think we all need to keep in mind that for fiscal year ended June 30th, 21, our land grant performance was in excess of 25%. And I know we're all reading a lot of things about how peer funds and university endowments are performing, and I think it's good to keep in mind what our performance was for the fiscal year. Dropping down to paragraph D, operations, we're now trying to hire 4 people. We've been looking for an accounting financial analyst now for months. They're very hard to find. We continue to look for a public equity analyst. It's hard for us to hire investment analysts at the compensation level we are authorized to offer. We're looking at real estate, real return analyst. So we have lost 2 excellent analysts over the past few months. It's very disturbing to us, both our public equity and our real estate analyst. We're looking for a fixed income analyst. I don't believe we posted that yet, but Keith is going to be doing that, and he's going to be searching for someone. With the growth in our net asset value and our FTEs, our allowed members of our staff, from 2010 to 2021, remembering that $21 billion in increased amounts that we are managing, our staff has been reduced from 31 authorized FTEs to just 26. We currently have 23 because of these recent departures we've suffered. We're going to need additional staff to manage the funds we have and the expected substantial new inflows that we're going to be receiving for our early childhood fund and other funds. I just want the council to be aware of the challenges we face in recruiting and in retaining qualified staff. Under E, our budget hearing will be on the 29th of this month. Investments and Pensions Oversight Committee is going to be meeting on the 12th of November. And our state land office royalty inflows have been remarkable. Brent will report on that, and we'd like the commissioner to comment as well. I have nothing else to add, Commissioner, but I'm happy to answer questions.
Hey, Steve, I missed, what did you want me to comment on?
How much money you're sending us every month.
Yeah, right. So we just hit a monthly high, y'all, for the first time, our October receipts, and remember that is reflects production from a 3-month lag. So that's August production is going to come in at $150 million for the month. You know, Steve mentioned the natural gas trends right now. I think that's a large reason why we're hitting these historic highs right now. But it's just kind of crazy if you think about, you know, the price of oil is steady and it's high, but it's not that high. It's, I think, more due to the efficiency of production and development and just getting the stuff out of the ground at this point. With technologies and everything, we're hitting greater and greater efficiencies all the time. So I don't know if anyone actually in the business wants to comment on that, but yeah, we hit a record month this month.
Commissioner, we don't have Scott Sheffield on our council. I wish we did. I was listening to a comment he made yesterday. I'm sure all of you know that Scott, a citizen of Santa Fe, is the CEO of Pioneer Natural Resources. I think he's one of the most well-informed people on the oil and gas business globally. And Scott commented on a call yesterday that they're not going to start drilling again. Pioneer's not going to start drilling again until they double their stock price. I found that to be an interesting way to look at things. Anyway, that's all I have.
Questions from council for Mr. Moise? All right. Hearing none, we're going to move to Mr. Smith for a Chief Investment Officer briefing.
Thank you, Madam Chair, and good morning, everyone. On the investment front, a full agenda for you today as you've reviewed the schedule and the materials. 4 new investments, including 2 for the New Mexico Private Equity Program, and a strategy recommendation, all for your consideration. We did have a full discussion at the investment committee meeting of the strategy recommendation, so we look forward to talking about that with you. On the macro front, there's not a lot new at the 30,000-foot level that we normally deal from. Other than what we've been discussing over the past few months, there's still concern over how long these higher levels of inflation will persist and what kind of damage will be done to consumers and the general economy when inflation does begin to ease. In that area, we are starting to see some consumer confidence surveys weaken, much due to hikes in food and gasoline prices, and durable good purchasing plans, surveys of that by consumers are beginning to pull back some. So we're starting to see some effect of what's been happening over the past few months on the inflation front. Secondly, there still remains, of course, strong interest by investors on how quickly the Fed will move on plans to slow bond purchases and bring interest rate increases back to the table for discussion. That's a direction they've been socializing for the past several months. Market impacts of both of those things really have been that longer-term interest rates have ticked up only a little bit, and the risk markets, stocks, credit, private equity, non-core real estate, investments such as those have mostly been shrugging the implications off. So still in a holding pattern a little bit. We continue to monitor and look for trends, changes, or strengthening anyway. In terms of investment performance and portfolio management, we have the August performance report for your review in the packet. RVK will lead you through that report. Preliminary September numbers are out, and the quarterly executive summary will be available shortly. That quarterly report, which we normally spend more time on with you, will be presented to the investment committee here in about 3 weeks and will be on your agenda for next month. We continue to deal with what we've been calling our high-class problem of significant portfolio cash levels. As a reminder, this is a function of significant cash flows back from our private investment portfolio, the return of both profits and capital, and continuing outstanding performance by the land office, as previously discussed this morning, in terms of contributions for the land grant fund, and also significant contributions and projections of even higher contributions for funds such as the Early Childhood Fund. We're managing through it with the overlay program that you reauthorized with very good timing, thank you, and are pursuing further means of getting this capital to work. We're currently researching a couple of other areas we think some of this money that's targeted for the private side of the portfolio that we can't get in there due to the illiquidity constraints. We think we can find some temporary public market solutions for that extra capital until it can get called into that side of the portfolio. So working pretty hard on that. In terms of operations, I regretfully inform you or reinform you this morning that Clay Camper, our outstanding investment analyst on the real estate and real return side, will be leaving us here in a couple of weeks. Obviously we're very disappointed in our loss, but personally I'm pleased that Clay will be staying within our world of public service. He's moving on to a larger public investment fund. I believe Clay is on the phone with us. Clay, we will definitely miss you, both professionally and personally, and wish you and your family the best. Keep doing the great job that you've been doing here in the public's interest. With Clay's departure, as Steve mentioned earlier, we have a significant shortage on the investment team now. We are actively recruiting for 2 investors and are positioning to move on to recruit 2 more after that to get back to full strength on the team. So, Madam Chair, with that, that's what I have.
So I wonder at this time if it would be all right, since you mentioned it, for folks just to kind of say their farewells to Clay, if anyone wants to say anything about Clay at this time.
Well, this is Harold, and I can tell you that Clay's done an incredible job. It's been awesome to have you be a part of this. I'm really sorry you're going. I'm not going to be quite as magnanimous as Vince. No, I'm kidding. I wish you only the best, and it's really been nice to have you involved with us. You've done a great job.
Much appreciated. Thanks, all. Very, very blessed and fortunate to have my position here, and was very happy to have it while I did, and look very fondly upon all my time here and the personal and professional growth I was able to have. So thank you for the kind words.
Thank you, Clay. You've been an asset to the team. We'll miss you. Going to go on now. Are there council questions for Vince?
Madam Chair, this is Harold again. I believe I read in the last few days, and I'm not sure the other fund, I think it may have been the ERB, discussion about freeing up the fund to be able to make the salaries more competitive, and especially in this atmosphere, but actually for some time now. Has there been any discussion about or possibility of discussing, and this might be something Debbie can address, but is there any possibility that we might be able to somehow figure out a way that our salaries for these particular positions, especially with a $21 billion gain in 10 years, is there any way that we could potentially take a look at freeing up some of these salary constraints? Because I hate to see us lose people. Although opportunities abound, we have to really look realistically that a lot of it has to do with the compensation.
Well, I can say from the investment side, Steve and I are talking about several different things that we potentially could do. Certainly, comp is among those. Steve might want to address further, but we're definitely talking and planning on things we can do to improve our position.
Harold, we have tried for years to improve our ability to compensate staff, to institute more pay equity, and to have more flexibility in budget and personnel. And we have not been successful. It's more difficult than it's ever been. And as Vince said, we're trying to find a way, but honestly, I have no idea how we'll be able to accomplish that.
If there's any way those of us on the council can get involved in helping trying to solve this, I'd sure like to hear about it.
At this point, I'm not sure that's well advised, Harold. Let your staff work on it a bit longer and a bit harder, and if we need some help, we'll certainly ask for it.
Great. Thank you.
Anyone else before we move to RVK? Thank you, Member Lavender. All right. Not sure who's on with us, Marcia or Matthias from RVK, but we'll hand it over to you for our monthly report.
Thank you, Madam Chair. Both Matthias and I are on the line, but I'm going to be taking care of the flash, and Matthias will be speaking to you later. Again, good morning, Madam Chair and council members. This is beginning on, I'll start on page 16, looking at the monthly flash. This goes back to August. A lot has changed. But just to step back to August, put things in perspective, and then looking at page 16 on the bottom right, you can see that global equities had nice gains for the most part in August. That was mostly supported by Chairman Powell's speech at Jackson Hole that was considered dovish. So equities ended the month strong. On the fixed income side, globally, bond yields rose in August, meaning prices fell. And then, as you well know, commodities in August fell, and energy component was underperforming at that time. So just, again, taking us back to August, just a brief review. I will mention that rolling forward, when we look at September, actually equity markets in September, stock market was the worst September in over a decade. So different from August, September, equities were down. A lot of that was triggered by the concern in China, but also as we're still facing the supply chain constraints that we're experiencing. And also in September, bond yields rose. In October, we're seeing better equity markets for the month so far, positive across the board for equities, with fixed income, again, negative so far in October. So with that said, we'll go back to August and look at your report. I'm going to take you to page 18. At the bottom where you can see the performance for the total fund was up for the month 0.98. Fiscal year to date up 0.127. That's for the total fund. If we look at land grant and severance, which are below, land grant for the month was up over 1%, and on the fiscal year to date basis, up over 1.3% on fiscal year, really just July and August. The difference in the land grant performance and the severance fiscal year to date again has to do with the difference in the private equity programs. Most of that comes from that. But looking at your longer, you can see some slight underperformance for the fiscal year to date, but looking longer term out to 5 years, 7 year, and 10 year, you can see the land grant has outperformed its mark. Speaking to what Vince mentioned earlier, if you look at
hey, for
the
those
top and middle on the...
Can you please mute yourself? As soon as you come on, you need to mute. Please mute yourself.
Thank
Sorry,
you.
Marsha.
No, thank you. Just to show what Vince was speaking to, you do have a high-class problem. You have money coming in. You can see that reflected where you're off target for more of your private investments, where you're underweight. And again, staff is working on solutions there. Going to page, if we go to page 19, again, you can see the allocation versus target for 2 additional funds, but I'll take you to page 20 and point out that early childhood did have an allocation change approved by the council, and you see staff has been implementing that and getting to that more diversified, more growth target allocation than it was prior to the council's approval. Page 21 looks at calendar year to date. The top bucket is looking at the total fund, beginning market value, and then ending market value as of August 31st. The net, obviously there's net cash inflows, and you've experienced a nice gain. Right below that is a land grant where you can see that again, the net cash inflows, and then an investment gain of over $2.5 billion. I'm now going to take you to page 24 of Diligence, page 10 of the RBK book. This is a monthly flash, so we don't have, we call it preliminary. It's because it does not have your private investments. They're valued on a quarterly basis for the most part, so more to come in September on that. But again, looking at that return for the month of 0.98 and breaking it out by land grant and severance, but then by the asset class composites, Looking at global equity, underperformance relative to the benchmark, you see the degree to underperformance, 16 basis points. But if we look below that and look at U.S. equity and non-U.S. equity, you see that they both trailed their benchmarks for the month. But if you look longer term, you can see some underperformance for the fiscal year to date, but the degree to which the U.S. equity portfolio has trailed its benchmark is far less than it was. There's been some restructuring there, and for a calendar year to date, it's positive relative to its benchmark. Non-U.S., more outperformance there calendar year to date, and the 1 year trailing, but has had nice outperformance. Other than that, if you look at the combined U.S. and non-U.S. equity portfolio and take that up to the global, you might say, okay, well, U.S. was up 2.73 and you were up 1.83 for non-U.S. equity. You were, relative to the benchmark for that time period, you had a little less exposure to U.S. relative to the benchmark, so that was a bit of a headwind. But again, improvements to both of those portfolios, it's been reflected in the numbers. On core fixed income, negative benchmark returns for the month, but you had a positive return despite the Treasury portfolio, which had a negative return. Your other pieces of that core fixed income composite did nicely. Non-core portfolio performed better than core, up 2.23% for the month. And again, that diversification of having core and then non-core more focused on income has been a nice complement to the portfolio. Page 25, again, these are looking at private, so you'll see no returns. So we'll talk more about those in September when we have updated returns. There is a very small piece of the pie under financial real return that are valued for Flash. You can see a negative return there. The biggest piece of that is the MLPs, but still a very small allocation. With that said, since this is a Flash, that's all we're planning on sharing. We're happy to stand for any questions.
Thank you, Marcia. Questions for RBK?
Commissioner, this is Steve. If I may interrupt for just a moment, we would appreciate it if everyone would please introduce themselves before they speak, because we're going to need to know that for the minutes. Thank you.
Thank you, Steve. I'm sorry. This is Marcia Beard from RBK.
And actually also for our members from the public joining us on the YouTube channel. So that's a good reminder. Thank you, Steve. All right. With that, we're going to go to agenda item 3A, and I'll turn it over to the chairman of our investment committee, Member Lavender.
Madam Chair, this is Mike Messina.
Member Messina.
Yes. Member Lavender called me and told me he might be a little late, so he asked.
That's exactly right, and I think you're young enough that you could be in a position to be involved for 20 years.
So, Harold, are you on now?
Member Lavender?
I apologize. I'm sorry. I've had all kinds of technological issues here in the last 2 minutes. What I wanted to, for the investment part, I'm going to really let Vince and RVK take it away. We had a really busy meeting 2 weeks ago. We've got the 4 major items here to approve the investments, and then we have the discussion about changing our long-term goals. So without any further ado, and I apologize for the little bit of turmoil, turn it over to Vince.
Thanks, Chairman Lavender. Madam Chair, I don't really have any further comments other than what we made earlier, and we'll get to the strategy recommendation on the return target after our investment presentations.
Great. All right. So then in that case, I will turn it over to Mr. Sable and Axia to present our first voting item, which is an investment into Sixth Street Growth Partners 2. If we could just remember, folks, to introduce ourselves before we speak. That goes for both the SIC staff, Axia folks, and then any reps we have from the actual investment.
Thank you, Madam Chair, and good morning, council members. This is Keith Sable speaking. I'm the director of the fixed income asset class for the New Mexico SIC. New Mexico SIC staff, in consultation with Axia, recommend a commitment of up to $75 million to the Sixth Street Growth Partners 2 LP and up to $25 million to the Sixth Street Growth Partners 2 sidecar. Sixth Street seeks to raise $3.5 billion in the main fund and $750 million for the sidecar. Main fund targets a gross return in the mid-teens. We seek approval in a single action for these two vehicles because they are similar in most material respects, except that the sidecar finances slightly smaller, earlier stage companies, offers discounted fees relative to the main fund, and offers a slightly higher rate of return. Allocations have been tight for this portfolio, and the GP has reserved space for us, in part based on prior relationship with Sixth Street. I would mention that we have one portfolio on the private credit side with them already, and also one in private equity. I'm joined in this presentation by representatives from Axia, including Trevor Jackson, Dylan Herman, Glenn Morisano, and Rebecca Hoon, and from Sixth Street by Brian Darcy and Mike McGinn. In order to minimize the redundancy here, I'll provide just a very high-level overview of the portfolio and then hand off to the remainder of the team to fill in the necessary details. The general partner seeks to provide bespoke capital solutions to high-performing companies in growth industries, including enterprise software, financial technology, tech-enabled businesses, and business services. Companies such as these often require an infusion of capital prior to profitability or an IPO or other strategic event. Founders and or sponsors often prefer capital sources that are less dilutive than an outright sale of equity and less restrictive than traditional credit. This is the niche that is targeted by Growth Partners 2 and its sidecar. In structuring these bespoke solutions for such companies, Sixth Street seeks to construct positions that are conservatively underwritten near the top of the capital stack and focused on downside protection. Depending on the cycle, business cycle, and company considerations, the GP solution may focus on downside protection and contractual return components, or on strong base case returns with increased emphasis on upside capture. The latter cases are typically a function of market declines, creating opportunities to structure positions as combinations of debt and equity, or warrants, or convertible securities. We believe GP's strong track record indicates proficiency both in underwriting growth companies and in opportunistically matching structures to market opportunities. One other key feature that we liked about this investment is that Sixth Street's unique sourcing platform often allows it to be the only credit provider involved in its transactions. This strengthens the GP's position and ability to influence the borrower and reduces the likelihood that any of the portfolio's investments will overlap with our existing portfolio holdings. It's a long way of saying it helps make for a strong diversifying element to our overall private credit strategy. It's important to note that warrants, convertible securities, payment in kind interest, and other blended stock and debt positions do expose this mezzanine strategy to more equity risk than a senior lending strategy would typically have. The trade-off for this risk is the ability to participate in some of the upside of a borrower's business when it performs as expected. That's a feature that's not available in a senior debt strategy. As an additional point of interest, I would also highlight that R. Martin Chavez, who is an Albuquerque Academy alum, has recently joined Sixth Street as vice chair. In conclusion, staff believes that the Sixth Street Growth 2 LP and its companion sidecar together offer an attractive total return opportunity for the private credit portfolio. We therefore recommend an allocation of up to $75 million in the main fund and $25 million in the sidecar be approved. With that, I'll hand over to Trevor Jackson to present the Axia underwriting.
Thank you, Keith. Good morning, council members. Trevor Jackson with Axia. As Keith mentioned, 6th Street Mezzanine Structured Equity Strategy Fund, offering mid-teens to higher teens when you include the sidecar in growth-oriented companies across equity-oriented and debt-focused investments. These investments are mainly in tech and tech-enabled companies, a significant growth area in today's market, as we know, and future markets. And so when we look at, from an Axia standpoint, and your non-core fixed income portfolio, we want to have diversification that fits in nicely in your distress and other category, and this really fits in more in the other category. We continue to look for diverse options in this non-core fixed income book, both at the strategy level, type, geographic, and sector level. So you have here, something you really don't have a huge exposure to is this tech-enabled, growth-oriented category. I'm going to turn over to my colleague, Glenn Morisano, who is a senior research analyst who did the due diligence on 6th Street to walk through the strategy. We also have Rebecca Hune from our operational due diligence team if any questions come up on the ODD side. I'll turn it over to Glenn.
Okay. Thank you, Trevor. And hello, everyone. This is Glenn Morisano with Axia. So just to recap, we conducted full investment and operational due diligence on 6th Street Growth Partners 2, which is the second vintage of this non-controlled structured capital strategy for growth-oriented businesses. Axia overall is quite familiar with 6th Street, having completed due diligence on multiple 6th Street products, including Tau Contingent, Tau 5.0, 6th Street Opportunities 5, 6th Street Specialty Lending Europe, and 6th Street Fundamental Strategies. And we've advised several clients on their investments across their platform. Today, I'll give you a brief background and overview of the fund and our findings. 6th Street was founded in 2009 by 7 former senior investment professionals from Goldman Sachs' Special Situations Group, which is their on-balance sheet investment business, and it is currently one of the largest alternative credit managers in the world, with over $50 billion in assets under management. The growth strategy itself has evolved over time, with earliest investments being primarily in the opportunities and Tau strategies, with a distinct commingled fund being raised in 2018. The team today has approximately 15 investment professionals. The growth team is led by Bill Stanley and Mike McGinn, who are co-heads of the strategy. Mike McGinn joined 6th Street in 2018 and was formerly co-head of Goldman Sachs Special Situation Group's growth capital business, focused on this type of investing. Bo Stanley joined 6th Street in 2011 and was previously with Wells Fargo Capital Finance. 6th Street, as mentioned, also has a group of senior advisors that is comprised of several executive-level individuals with operational expertise and overall sourcing and industry networking relationships that should benefit the companies. As mentioned, Marty Chavez, formerly CFO and Chief Information Officer of Goldman Sachs, is now Vice Chair and is also one of these growth senior advisors. 6th Street is currently raising the fund, which is anticipated to have $3.5 billion in capital commitments, as Keith mentioned. The credit profiles of these borrowers can feature negative EBITDA and cash flows, though issuers would generally have $50 million plus in revenues in the main fund, being slightly smaller in the smaller vehicle. These businesses generally have recurring revenue models, and 6th Street is targeting 100% plus net retention rates, with LTVs ranging generally from 10 to 65%, so pretty senior in the capital stack. As mentioned, this is a non-control-oriented strategy with the expectation in the main fund that there is a near-term catalyst to liquidity, whether it's an IPO, outright sale, or another venture capital raise. The portfolio itself is currently expected to be divided amongst 3 primary transaction types, the first being convex growth, which is an equity-oriented style transaction, currently expected to be 30 or 40% of the portfolio. Hybrid capital solutions, which are both debt and equity investments stapled together, which is expected to be around 20 or 30% of the book. And then growth yield, which are primarily debt-focused investments, another 30 to 40% of the overall portfolio. Returns can have PIK and can have PIK contractual rates of return and liquidation preferences, and can have varying covenant protections ranging from outright formal maintenance covenants such as minimum liquidity, ARR, and other interest coverage or leverage ratio covenants, to more negative covenant structures, which prohibit corporate actions like debt and equity incurrence, dividends, and overall corporate events that might be adverse to Sixth Street's position in the capital structure. The investment period for the fund is 4 years from the final close. The harvest period is also 4 years as well. The management fee structure for non-founders, which would be defined as commitments less than $200 million, would be 1.25% on unused commitments and 1.5% on invested capital during the commitment period. During the post-commitment period, it would be 1.5% on the lower of actively invested capital and NAV. As mentioned, the management fee structure on the sidecar is discounted to the main vehicle. During the investment period, this would be 0% on unused commitments in the investment period and 1.25% on invested capital. And both vehicles will have identical carried interest and incentive fee allocations, with a 20% carried interest fee subject to an 8% preferred return and 100% GP catch-up. The waterfall will be American style. In terms of merits, the key merits for the platform from our perspective are the scale, differentiated deal flow, experience of the team, and resources of the platform. The overall platform track record, as mentioned, Axia has performed full investment due diligence and reviews on other Sixth Street funds, and inclusive of TAO, fundamental strategies, and opportunities. Overall, we have found that performance has been standout across the platform compared to other alternative credit platforms. The growth series initial fund as well has performed quite well as well. So just wanted to highlight that when we did our underwriting. The team itself is also focused on the investment verticals that the fund will target, with team members having prior experience from growth equity and venture platforms such as Battery Ventures, SoftBank, General Atlantic, and others. Key considerations would include, we would just want to note that Growth One is relatively early in its life, and that the overall kind of growth of the Sixth Street platform over time. That said, we do believe that the forward-looking opportunity set is attractive for Growth Two, and that the team is structured to capitalize on the environment, particularly given the underlying strength in the software, tech, and healthcare industries. So I hope that this was a helpful overview for you all, and we're of course happy to answer any questions that you might have. Thank you.
Mr.
Keith, this is Brian Darcy. Should I pick it up from here from the Sixth Street folks?
That's exactly what I was just going to do. Thank you, sir.
Great. By the way, Glenn, Keith, I appreciate what a great job you did. Hopefully we're not going to repeat a lot of the intro, but thanks for all the introductory remarks. This is Brian Darcy. I'm a partner here at Sixth Street, where I oversee capital markets and strategy. As the folks said before me, I'm joined here by my partner, Mike McGinn, who is co-head of Sixth Street Growth. I'll make a couple of high-level comments on Sixth Street as a whole, and then turn it over to Mike to spend a little bit of time talking about specifically our growth business. Before I do so, I do want to call out, we started our partnership together, ourselves and the Investment Council, back in 2014. We're super thankful for all of your support and partnership, and should go without saying, but we're going to continue working super hard for all of you and your beneficiaries, and really appreciate the trust and partnership over a number of years now. As folks said before me, Sixth Street today, we're a $52 billion opportunistic investment firm, really run by a partner group who collectively has been working together for, 15 plus years. And the hallmarks of how we invest across business units, agnostic of growth or, our opportunities funds or our lending series, is really 5 key characteristics. We have, number one, a one-team culture. We've worked together a very long time. We are not predicated on any one singular individual, but it's really about the entire partner group and the team. And a bit unique to our culture, we all like each other. We want to be here working together, and we have a super collaborative culture within Sixth Street. Number two, all of our investments, all of our funds are really around an engine of rotating themes. We're a very theme-based investment firm, constantly migrating in and out of different attractive themes as they come and go. sourcing here is treated as a business. We focus on outbound direct-to-company sourcing to create unique opportunities. Number 4, capabilities to attack any theme anywhere in the world. We want to be well-positioned that as themes come up, recycle in, create interesting pockets of opportunity. We want to have the capabilities to go attack them. And then lastly, and equally as importantly, we have a super tight risk mentality, always focused on compounding capital, driving, very attractive risk-adjusted returns over a very long time frame. I'll turn it over to Mike to spend a little time specifically talking about our growth platform. As Mike will talk about, this is a platform that goes back over 15 years, and today we're going to talk specifically about our main growth fund as well as our sidecar vehicle. Mike?
Thanks, Brian. As Brian mentioned, I'm Michael McGinn, partner at Sixth Street and co-head of our growth business. First, thanks again for the longstanding support of Sixth Street and the opportunity to meet with you this morning to present Sixth Street's growth franchise. I'd echo Brian's comments that Keith and the Axia team did a great job introducing the strategy, so I'll just focus on expounding on a couple of the key elements that each highlighted. Our second growth fund follows the first dedicated Sixth Street growth vehicle, which we raised in 2018 and 19, and currently reports returns of 27.1% net IRRs through June. I'm not going to go through every page, but I will start on the Sixth Street growth platform slide, which should be slide 5 of the deck. And here what this highlights is a few things. Number 1, as Brian mentioned, the strategy dates back over 15 years. Since the founding of Sixth Street in 2009, the strategy has invested nearly $6 billion of capital in this strategy with gross returns of about 27%, and importantly, no losses. This is a high hit rate strategy, which we'll talk about, but the strategy, like to date at Sixth Street, has not experienced losses. Many of these company logos, shown on this page, or many of the companies we invested in are shown here on this page. We're super proud and thankful for the opportunity to have partnered with them, over time. If we go to the next page, we'll focus on a couple of the key elements of the strategy. So first, as Brian mentioned, we are thematic investors. So we are looking for defensively positioned, secularly growing, late-stage companies. That typically what that means for us is these companies have a large percentage of recurring revenue. They offer sticky, mission-critical products evidenced by high annual revenue retention rates. They have attractive unit economics and boast very strong management teams. In terms of sourcing, we like to contact our companies directly, forge relationships, and work to structure creative financing solutions for them that fit the exact objective of what they're looking to achieve when they're raising capital. In addition, after our investment, we typically work with our portfolio companies to help improve the growth trajectory of the business and offer more than just capital to our portfolio companies. The next page, I would touch on the fact that we think that this is a through-the-cycle strategy, as evidenced by the fact that we've been pursuing it for, well over a decade. We've invested through various market environments, both, kind of characterized by high asset prices, as well as, through periods of market dislocations. We're comfortable investing through each of those market backdrops, and we can often toggle our investment structures and proposals given where we are in an investment cycle and where the company is in their in the specific part of their growth trajectory and life cycle. As Brian mentioned, we have a protected downside, high hit rate strategy. So regardless of where we are in a market cycle, we're focused on minimizing the risk of principal loss and earning an attractive return on capital. As we flip, I would just highlight a couple of other points. As you can see on page 8 of the private deck, we have been able to navigate these various market environments with different return compositions through periods. In the current asset price environment, we're really focused on the highest quality companies and picking our spots in what is a pretty high asset price environment. Life to date, the portfolio has tended to be focused on North American companies. It's balanced across what we call the various hunting grounds of the types of structures that we invest through, growth yield, investments with greater convexity, and then a hybrid mix that would combine both elements of credit and equity. But again, high hit rate, focus on the downside through every investment type. And then, as mentioned, we're investing, we're pursuing these companies directly. We're forging direct relationships with these companies. So the composition of our portfolio to date has tended to have little overlap with other GPs, with over 85% of our investments where we're the sole GP. Forward onto page 14, this is a snapshot of our portfolio to date. A couple things that we would highlight here. This is a diversified portfolio. We've got about 25 to 30 portfolio companies. We think diversification is important in the strategy. As you can see, this lies in, as mentioned, our core verticals of software, fintech, and healthcare IT. With that, I can pause there before talking, briefly about our mid-stage fund, which is the second vehicle that we're currently in the market with and is an extension of our growth strategy.
Yeah, Mike, why don't you give some kind of remarks there, and then maybe we'll just pause for questions.
Sure. So the mid-stage strategy it takes our late-stage growth strategy and applies it to companies slightly earlier in their growth journey. The strategy emanated from conversations we had with founders and CEOs in recent years as part of our direct-to-company outreach. We met a lot of great growth companies that were looking for flexible capital, but they were just a little earlier in their business build than the focus of our late-stage strategy. So same defensively positioned, secularly growing businesses, same high-quality businesses featuring recurring revenues, high retention rates, attractive unit economics, and strong management teams. Just the average profile of these businesses, they're likely to have, $10 to $50 million of recurring revenues, versus $100 million plus of recurring revenues. But again, these would lie in our core verticals of software, fintech, and healthcare IT. And so we're leveraging deep industry knowledge, industry relationships, to help identify great secularly growing businesses that are going to continue to take share and build great businesses over time. I think with that, I'm happy to pause and flip it to questions or go deeper on anything that folks would like.
Thank you, Mr. McGinn and Mr. Darcy. We're going to now turn it over to the council to see if anyone has questions either for our staff, our consultants at Axia, or the representatives from 6th Street. Council questions.
Madam Chair, I'll jump in. We had a very good discussion at the investment committee about this investment. A number of questions, some of which were covered today. And the committee was unanimous in its recommendation to the council that this be approved.
Anyone else? All right, I will take a motion for approval at this time.
Based on the recommendation, this is Harold. Based on the recommendation of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $75 million in 6th Street Growth Partners 2 and up to $25 million in 6th Street Partners 2 sidecar, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second, Nick.
All right, we've got a proper motion and a second. We're going to, as you heard in the motion, take both the investment and the sidecar investment at the same time. So do we have any discussion on a motion to approve this investment? All right, I'm going to have Andy call the roll on a motion to approve the investment into Sixth Street Growth Partners 2.
Commissioner Garcia-Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg. Treasurer Eichenberg.
He actually said he was probably going to pop off and then come back on later.
Okay. Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion is unanimously approved.
Thank you, Andy. And we thank the folks from Sixth Street for being on the line with us to give us the presentation. Thank you.
Thank you for the opportunity.
Member
Madam
Messina.
Chair? Yes, thank you. Listen, I have an appointment, so I'm going to have to leave the meeting right now. Just wanted you to be aware.
I appreciate the heads up. Thank you, Member Messina. I believe we still do have a quorum, though, with 7 or 8 members still on. So we're going to continue.
Correct.
Okay, thank you, Andy. We'll go to agenda item C now for our second voting item of this meeting, and it is an investment into Menlo Special Ops 3. I'm going to turn it over to Mr. Lee and our consultants from MRSA.
Thank you, Madam Chair. This is David Lee, Director of Private Equity. I'm joined on the call by Chris Cassidy, Private Equity Portfolio Manager, Richard Pugmire and Amy Ridge from MRSA, and from Menlo Ventures, Venki Ganeshan, the Partner and Management Committee Member, and Kirsten Mello, the Chief Financial Officer. These materials start on page 122 of diligence for those following along. The special opportunities, or Inflection, we use those terms interchangeably. The strategy focuses on venture capital investments, predominantly in North America-based companies. The focus areas for the fund will be in cybersecurity and infrastructure, in fintech, software as a service, consumer, and life sciences. The Inflection Fund series seeks to exploit a gap that the firm identified between early-stage venture capital investing and growth investing. And the 3 dedicated partners are responsible for deployment of this fund independent of the venture investment team. Menlo Inflection 3 has a target of 30 companies in the fund with an average check size of between $20 and $40 million. That's seeking a 5 to 8% roughly ownership in companies that are Series B funding or later. Fund 3 is expected to invest roughly 40% of the commitments in follow-on investments from the Menlo Venture funds and 60% in new companies. The target size of Fund 3 is $750 million. Fund 2 of this series was $500 million in commitments. And the general partner commitment here is above average. It's expected to be between 3 and 4%. Historically, Menlo Ventures has been one of the world's premier venture capital firms and therefore difficult to access. Performance for these 2 Inflection funds has been strong, with a minimum 27% net IRR so far, and both funds currently rank in the second quartile versus the Burgess North American venture capital universe. It should also be noted that Menlo uses more conservative performance valuations for their portfolio companies than last round financing, which is common in this industry. Dividends to paid in capital, or DPI comparisons, are a bit less meaningful for venture capital given that these vintage years are 2016 and 2019. Menlo Ventures has a 43-person team, including 16 investment professionals and 4 employees in the portfolio services team called Menlo Fuel. Their main office is in Menlo Park, California, with a satellite office in San Francisco. In sum, staff and consultants are recommending a commitment of up to $45 million in Menlo Inflection 3, and this would be the second commitment to Menlo Ventures. Last year, we made a $30 million commitment to Menlo Ventures 15. And with that, I will turn it over to Amy Ridge of Mercer for some additional comments.
Great. Thank you, David, and good morning to everyone. This is Amy Ridge from Mercer. So David gave a great detailed presentation on the firm and fund. So what I wanted to do is focus on the key merits we like about this opportunity and then areas of consideration. So overall, we like that Menlo is a well-established premier venture capital firm with over a 40-year history, and it's one of the most recognizable brands in the venture space. This matters a lot when sourcing deals. It really makes them a highly sought out by many entrepreneurs and allows them access to strong deal flow. We also like that the Inflection team is comprised of experienced investors, and Menlo has generated a strong track record. Both of their previous Inflection funds are currently generating really strong above median returns, and we expect a lot of additional upside. As David mentioned, Menlo uses a more conservative valuation policy. Some key areas of consideration include just the expansion of platforms and strategies at the firm over time. They were founded as an early stage venture firm, but they've since expanded with the Inflection series we're discussing today, as well as healthcare investing and an incubator. But, they have scaled the team to ensure capacity for these expansion efforts, and the strategies are really complementary to one another. The other main area is terms. They do have some terms which are at the higher end of the market. However, on the whole, these terms really are more typical for the premier venture capital firms. And we really appreciate that the firm is making an above average GP commitment, which is expected to be 3 to 4%, which helps promote alignment between the firm and LPs, and has a longer vesting schedule for the leaders of the fund, which promotes retention of the senior team. So overall, we are favorable on Menlo as a firm and the addition of Inflection Fund 3 to your portfolio for a size of up to $45 million. Now I will turn it over to Benke and Kristen from Menlo, and then we're happy to take any questions you have after their presentation. I'll turn it over to you.
Thank you, Amy, and thank you, David, for the opportunity and for the presentation. Madam Chair and Council members, this is Benke Ganesan. I'm one of the managing partners of Menlo Ventures, and deeply grateful for the opportunity to present today. I'll just try to hit some high points. I'll be referring to the private presentation. Slide 2. We are a 45-year-old firm, and part of that history has been 500-plus portfolio companies, 75-plus public companies, and 160 M&As. We are very proud of the fact that the aggregate value of our portfolio today is over $373 billion, if you held all those companies, and that we have distributed $8 billion to our LPs net since 1977. All the numbers I'm going to say today are net. And if you look on page 3, you'll see our track record. Again, we are very proud of the fact that over this 45 years, this will be our 18th fund. We have, I think, clearly top-notch track record. And the Menlo MSOP 3, Menlo Inflection 3, would be our third fund in this series. The first 2 funds are 27% and 35% IRR. As both Amy and David mentioned, we use a much more conservative policy in our valuation. A lot of people in our industry use last round pricing, but we have chosen to take a discount of last round pricing because we think that better reflects and is more LP friendly. Page 4 just talks about the number of companies that we've been part of that over a $2 billion plus market cap. So we have had 20 companies that we have invested in that have resulted in a $2 billion plus market cap. Many times we are actually the first investor or have incubated the companies. For example, one of the leading healthcare companies in the world is a company called Gilead, which we incubated in our offices almost 25 years ago, and they are now close to a $90 billion market cap. We were early in Uber. We were the largest investors in Roku. So we've been fortunate to have invested in companies that are, I think really transforming the world we live in. I am going to talk about slide 9, which is, again, the private presentation. The pandemic, all the areas we invest in made sense prior to the pandemic, but the pandemic has accelerated those areas. Our total Menlo funds are up 123% from 3/31/20 to 6/30. So we have had a phenomenal increase in value because the areas we invest in, again, they made sense before the pandemic, but have really accelerated because of the pandemic. The pandemic has changed how we live, work, love, and play, and the areas we invest in play into that. And if you were to think about, I'm going to go to slide 16, which is the Inflection 3 focus areas. These are the focus areas we invest in. There are 5 areas. Cybersecurity, a very big area for us. I lead our cybersecurity practice. We think this is an important area in terms of everything we touch is going digital. FinTech, which is this notion that, our financial system is going to be transformed by technology. SaaS, digitization of business processes. Consumer, and life science and healthcare. So these are the 5 areas the Inflection Fund focuses on, and this will be the focus area for Inflection 3. I just want to give you a sense of the opportunity. In slide 13, we think Inflection 1 has the potential to be a 9x gross return, which would make it one of Menlo's best funds period in our 45-year history. Inflection 2 right now is tracking to be a 3 to 4x gross return. So we think the Inflection strategy allows you to get venture-like returns with a lot less risk, and it's very attractive. And with that, I will stop and take questions, and once again express my gratitude for having the opportunity to present. Thank you.
Thank you, Mr. Ganesan, and thank you to our team on the SIC staff and to Mercer for their consulting work on this investment opportunity. So with that, I'm going to turn it over now to council members for questions on this investment.
Once again, Madam Chair, this is Harold. We had a good discussion about Menlo, and the committee unanimously approved recommending this to the council.
All right. Thank you, Member Lavender. Any further questions from council? Okay, if not, I will take a motion.
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff in general, fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $45 million to Menlo Special Opportunities Fund 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Is there a second?
I'll second, Nick.
Okay, we've got a proper motion from Member Lavender, a second from Member Tejas. Any discussion on the motion? All right, Andy, will you call the roll on a motion to approve an investment into Menlo Special Ops 3?
Certainly. Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Has Treasurer Eichenberg rejoined the call? Okay. Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passed unanimously.
Thank you very much, Andy, and thank you to the folks on the line from Menlo for being here to present the investment. With that, we will turn it to we've got two investment opportunities to consider in our New Mexico private equity program. The first is agenda item 3B, which is an investment into Kitty Hawk 3. I'm going to turn it over to Mr. Cassidy and Mercer.
Thank you, Madam Chair. This morning I'm joined by Richard Pugmire from Mercer as well as Will Weissman from Kitty Hawk Ventures. Staff is recommending an emerging manager commitment as part of the New Mexico program of up to $5 million to Kitty Hawk Ventures 3. Kitty Hawk Ventures 3 is an early-stage venture capital fund that will invest in frontier technology opportunities that have the potential for exponential growth. We were introduced to Kitty Hawk by a local company, which Mr. Weissman has helped raise capital for, and he can discuss that as part of his presentation and why he's so interested in the opportunity there. Kitty Hawk was founded in 2015 by Mr. Weissman. Immediately prior to founding Kitty Hawk, he was the executive director of Singularity University. And earlier in his career, before that, he had been an investment professional at a number of venture capital firms. For those who are unfamiliar with Singularity, it's actually now referred to as Singularity Group, and the goal of it is to bring together individuals wanting to understand how they can use technology to tackle global challenges. The original corporate founding partners of it are big firms like Google, Nokia, Autodesk, LinkedIn, etc. Mr. Weissman developed a very impressive network during his time, during his 7 years at Singularity, which is part of the reason we think he's an interesting potential part of the New Mexico program. The reason behind stepping forward to the reason behind the emerging manager recommendation at this point, Kitty Hawk is a smaller firm with a little bit less institutional infrastructure and processes than we see with some other managers. It's not uncommon at this stage of development of firms like this to be here. He does have all the appropriate administrators and audit firms required as part of the commitment for the emerging manager program. On the positive side, we really like the fact that there's a very high GP commitment, including some very high-profile individuals that have personally invested significant amount of money, including a managing director who's a former executive of Clear Channel Communications. Mr. Weissman's also going to be bringing on a venture associate as part of this fundraising. We would be the last LP in this fund. He also has an excellent network. He has a network of 5 advisors and 12 venture partners, which help him source transactions as well as do due diligence on deals. So in that spirit, I'll pass it along to Richard Pugmire from Mercer.
Thanks, Chris. This is Richard Pugmire from Mercer. This is a new manager to the New Mexico program that falls under the emerging manager definition in the policy. Like Chris said, we came across Kitty Hawk from their recent investment activity in New Mexico. They've already made a sizable investment in a New Mexico aerospace company, which is actually in this fund that we're considering. Will Weissman, who is the founder of Kitty Hawk and on the phone with us today, believes there are more opportunities in New Mexico, and he's interested in building more relationships in the state and seeking additional investments, and we hope inclusion in the New Mexico program will help accelerate this. Chris did a great job summarizing the investments. I'll focus on some of the pros and considerations of our investment analysis on Kitty Hawk. I mean, this strategy fits the New Mexico program very well. The fund focuses on frontier technologies at the early stage in multiple areas, including financial technology, payments, blockchain, artificial intelligence, and machine learning, digital health, and aerospace, which are all expected to be kind of high growth areas over the long term. Will Weissman's background at Singularity and other venture capital firms has created a network in the technology community that should benefit Kitty Hawk's investments. And this is one of those things that we've talked about with the New Mexico program, where we really want managers who have the ability to create more connections for companies that are in the state, and we feel Mr. Weissman's network could benefit his New Mexico investments. There's a large commitment from members of the general partner, which is good for alignment with limited partners, and we feel that Will Weissman actually has really good alignment to see Kitty Hawk be successful. From a track record perspective, there have been some successes in the past, but it's not a deep track record at this point. There's not a lot of realization, so there's still some uncertainty there. On the consideration side, I mean, this fund is reliant on Will Weissman. It's different from funds that we see in the national program and a lot of what we see in the New Mexico program that have multiple team members. But the organization is still developing, and there's an expectation that the team's going to grow with the new fund and future funds. Another consideration is the capacity of Will Weissman. Fund 3 is going to be larger and make more investments. In addition, he's going to be responsible for managing the prior investments as well. But Kitty Hawk has added a team member to help with capacity, which definitely helps the situation. And we hope to see a larger of the organization continue to evolve in a positive direction, which it has been doing so far to date. Terms is another consideration. Management fees at the high end of what we see in venture capital, but that's not unexpected given the firm really doesn't manage a lot of capital. There's also no cap on organizational expenses, but that could potentially be addressed during legal negotiations. So Kitty Hawk falls under the emerging manager definition in the New Mexico program policy, and we reviewed the criteria for a fund in that definition, and Kitty Hawk fits. Consistent with the policy, the commitment is sized at $5 million. And with that, I'm going to turn the time over to Will Weissman for a short presentation.
Good morning, everyone. Thank you, David. Thank you, Richard. Thank you, Chris, so much for your time and for the opportunity to be here. My name is Will Weissman. I'm the founder and managing director of Kitty Hawk, and it truly is a great pleasure to be joining you today. So it's my belief that we are living in a really extraordinary time. And new technologies, increasingly powerful existing ones, and many of these driven by the exponential growth of technology, are going to lead to the development of extraordinary new products, new industries, and new ways to move humanity forward. Kitty Hawk was born in 2015 at Singularity University. Singularity is a think tank and educator that was started by inventor and futurist Ray Kurzweil, and Peter Diamandis, the founder of XPRIZE, also an author and entrepreneur. And it's a place where many of the world's brightest minds have convened to attack the world's toughest challenges by leveraging these accelerating technologies. And the university brings together some of the world's leading thinkers, entrepreneurs, and investors, and has been really an incredible place for me to be able to form a deep network of relationships and to get unique insights into where the world is going. Kitty Hawk leverages this unique vantage point to invest in world-changing entrepreneurs and companies that bring positive change to people and the planet while providing top returns to investors. Kitty Hawk is focused on making seed investments in these exponential technology areas that we believe have the greatest potential for 100x outcomes and, again, significant positive global impact. These include space, advanced materials, robotics, synthetic biology, fintech, longevity, and healthcare, among others. A big part of our strategy as a small fund is to partner with extraordinary experts to leverage their networks and to create unique opportunities for Kitty Hawk. Today, we have 12 individuals who serve as Kitty Hawk Venture Partners, and this network of really world-class business leaders and technologists assist us with sourcing and vetting investment opportunities and give us access to deals and expertise in a wide range of areas. Kitty Hawk was launched in 2015 with individual investments and syndicates that were grouped into a first fund, Kitty Hawk Ventures 1. As of Q1, that fund was marked to 3.31x invested capital and has a 44% IRR. In December of 2018, we began investing out of Kitty Hawk Ventures 2. Ultimately, we built that up to a portfolio of 17 companies, and that fund is marked to 2.9x invested capital and has an 80% IRR, again, as of Q1. We're also excited to share that we've been able to achieve these returns while maintaining a very low loss rate, which is very unusual for early stage frontier technology investing. In our 6 years of investing under Kitty Hawk, we've only lost 2 of our 25 portfolio companies. And we believe the combination of this low loss rate and our ability to invest in top high growth technology startups mean that both of these funds have a very, very long way to run. As was alluded to, in 2020, we began expanding our team, and Randall Mays joined Kitty Hawk as a managing director and as my anchor investor. While my expertise has been around the earliest stages of entrepreneurship, Randall has deep experience with later stage companies. Randall was the former vice chairman and president of Clear Channel Communications and the CEO of Clear Channel Entertainment, which became Live Nation. He's run a large global public company with over 40,000 employees, and as a result brings really terrific operating experience to help our portfolio companies as they scale. We're now in the final stages of closing Kitty Hawk 3 and are grateful to have the opportunity to potentially partner with the state of New Mexico. This fund will continue the seed through Series A investment strategy that we've successfully executed in Funds 1 and 2. And for this fund, the general partners are committing 26% of the total capital, so we are extremely aligned and incentivized to provide a great financial outcome for the fund. We're also very excited about the opportunity to form deeper connections into the state of New Mexico. We believe that the development of space and the broader aerospace economy is really in its infancy, and that these are areas that represent an extraordinary opportunity for both financial gains and positive impact. Kitty Hawk has identified New Mexico as an important part of this developing ecosystem, and we're really looking to get increasingly engaged with this community. As part of our commitment to New Mexico, Kitty Hawk has made its first investment into a New Mexico-based aerospace company called Sky. Sky is building out a fleet of large airships that reside in the stratosphere at 65,000 feet and provide important telecommunications and Earth observation capabilities. The company is headquartered in Moriarty and also has a hangar in Roswell. So in August of this year, we made our largest investment ever by investing $15 million into Sky. That's a combination of funds from Kitty Hawk Ventures 3 that we're talking about today and a sidecar vehicle. We led the firm's Series B, which will raise a total of $50 million for the company, and have taken an active role with them, including joining as a board member. So this is one of the very first investments we've made out of the fund that the State Investment Council is considering today. So Sky is still in the development phase, but we're extremely excited about it because we think it has the potential to not only build an important business and very large business, but that it can also have a very significant impact on the population of New Mexico and the world at large. The company is deeply engaged with the New Mexico state government. Sky's technology can help bring consistent, high-speed internet and cellular services directly to handheld devices and thus provide access to the New Mexico citizens that currently don't have regular coverage, and also has really important Earth observation use cases, including spotting forest fires as well as detecting air and water pollution. Kitty Hawk has also, with the help of introductions from Chris Cassidy and David Lee, begun building relationships in the state with investors who share a similar focus and a desire to find great companies in New Mexico, as well as play a role in supporting a more active startup ecosystem. These have included Scout Ventures, 110 Capital, and Crosslink. As part of our efforts, Kitty Hawk will seek to connect with leading schools, labs, incubators, accelerators, and other investors as we seek to find promising early-stage businesses and important technologies to back. We're interested in building a long-term and accretive partnership with the State Investment Council. We think that our expansive network of deep relationships with leading technologists, entrepreneurs, thought leaders, and capital providers can really help emerging technologies and companies in New Mexico and beyond realize outsized success. We look forward to working together with you all to make that happen and very much appreciate your consideration and the opportunity to speak with you today. And if there are any questions I can answer, I would be happy to do so. Thank you.
Good, Mr. Wiseman. We appreciate you being here with us today. So we're going to now turn it over to questions from the council.
Madam Chair, it's Harold. Once again, the investment committee spent a large amount of time on this investment, and we recommend, the council unanimously recommend approval.
Thank you, Member Lavender. Any further
Madam Chairman?
Yes, Member Jennings.
Yeah, I'm going to ask to be excused from voting on this because I think they have a significant issue of investments in Roswell, and I would like to I'd like to be excused from voting on this because I've been involved in some of those issues.
Okay, Member Jennings, that is noted. And so I don't know, Steve, if we mark him down as abstained or just leave him out of the vote tally.
Is that an abstention?
Yes, for me it is.
Okay. So if you could just say that when Andy calls your name, I think that would work.
Okay, thank you.
If you're ready, Madam Chair, based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and general fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $5 million to Kitty Hawk Ventures 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do we have a second?
Second, John Bingaman.
All right, great. We have a proper motion by Member Lavender, a second by Member Bingaman. Any further discussion on this motion? All right, with that, we'll have Andy call the roll on a motion on the investment into Kitty Hawk 3.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Mr. Jennings.
Abstain.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes with 6 in favor, 1 not in favor, and Mr. Jennings abstained.
Okay, very good. I appreciate that. Thank you very much, and thank you to Mr. Wiseman for being on with us today. Good luck.
Thank you so much. Such a pleasure, and so excited about the opportunity to work with you all. Thank you.
Same here, same here. All right, great. With that, we're going to turn it over to, we're going to go to agenda item 3E, our last investment of this meeting. It's another New Mexico program, private equity investment into SARACAP 3. And once again, Mr. Cassidy.
Thank you, Madam Chair. Again, I'm joined by Richard Pugmire from Mercer and a number of people on the investment team at SARACAP, including managing partner Sharab Suri and partner Ritesh Agarwal. SARACAP we're recommending a fund commitment to SARACAP Ventures 3. It could be the recommendation is a potential of up to $10 million, depending on how much capital they raise. So the commitment would start at $5 million based on where they are on their current fundraise, and has the potential to increase up to $10 million depending on how much capital they're able to raise and the size of the ultimate fund. This firm was created by a group of individuals that work together at UST Global, which is a large multinational digital and tech services firm. The funds will be focused on cybersecurity, enterprise AI, and health technology. This team, from their time at UST Global, have relationship with chief investment officers of large companies all around the world. And their investment strategy is to invest in the sectors that I mentioned and help portfolio companies drive purchase orders and customer introductions to what they call their sales and scale model. I won't go into too much more of that so I don't steal their thunder for later. But in terms of the New Mexico connection, one of their portfolio companies is currently in process of moving staff to New Mexico. SARACAP is considering opening a branch office in New Mexico. And over the course of their Fund 3, they intend to invest in select opportunities in New Mexico, potentially up to 4 or 5 companies, typically at the very early incubation or seed stage. And I'll pass it on to Richard from Mercer to discuss the investment in more detail.
Thanks, Chris. This is Richard Pugmire from Mercer. We've been talking to the SARACAP team for more than a year and a half now since they were in the market with their last fund. They've talked about their excitement with New Mexico and the potential that they're seeing in the state. They've invested in 3 companies that are based in New Mexico or had technology that was started and incubated in New Mexico, so they're familiar with the state. And then we've really seen over the last year and a half how they've looked more at the opportunities in the state and came up with a plan on how to do further investments in New Mexico. And not only have they raised capital for New Mexico companies, but they're moving one of their portfolio companies to New Mexico, as Chris mentioned, and they're looking to potentially move other portfolio companies. Their goal in this fund is to invest in 4 to 5 companies based in New Mexico and potentially invest up to 10% of their $100 million fund. They're also going to look at potentially opening an office in New Mexico staffed by a partner to be an important part of that ecosystem. And looking at our evaluation, we really like SARACAP's approach to adding value to companies. The team has a global network from their work at UST Global, and they really leverage that to help bring revenue to the portfolio companies by introducing them to larger multinational corporations. The firm particularly has a network in Asia with a partner located in Singapore. And this goes back to the point that we made on Kitty Hawk, where we want firms in the New Mexico program that can add value to companies through introductions. And it appears that SARACAP has done that in prior investments with this introduction to large multinational corporations, which brings revenue to earlier stage companies. The team, which is pretty sizable for a firm of its size, has a long history working together. Previously at UST Global before starting SARACAP, the firm broadly shares carried interest as well, which is the profit sharing from the fund within the partner group, which also helps with alignment with investors such as the SIC, as many members of that firm are going to be focused on maximizing returns. Some of the considerations that came from our analysis, the track record is somewhat unproven at this stage. There have been successes in the prior funds, but without more sizable realizations, relative returns compared against the venture capital benchmark are not as compelling currently. But with venture capital, that can change with one sizable realization given the volatility of the asset class. SARACAP's also early in its fundraise and is targeting a larger fund. It is a competitive fundraising market right now, and SARACAP's going to be targeting some new investors with its fund. From a terms perspective, management fees are at the high end of what we see, although, given SARACAP's size, that's not unexpected. There's also no cap on organizational expenses, which, we like to see. We've talked to SARACAP about it. They don't think it's going to be a large expense, but it's still nice to kind of have a cap for protection for limited partners. But that's something that can be worked out in legal negotiations. While there are uncertainties found in the diligence process, we feel SARACAP is a good addition to the New Mexico program, given that expertise that they bring and also their prior activities in the state. We sized the recommended commitment as $5 million today as they're early in their fundraise, with the potential to increase to $10 million as they raise more capital in the fund. And with that, I'd like to introduce Saurabh Suri, who's the managing partner at SARACAP, and Ritesh Agarwal, who's a partner at SARACAP, and they're going to give a short presentation.
Thank you very much, Richard. Very good morning, Madam Chair and Council members. My name is Saurabh Suri, and I'm the managing partner at SARACAP Ventures. I also have in the call with me my partner, Ritesh Agarwal. And actually, a special thanks to David, Chris, and Richard for putting us through our paces and the great overview. We're really grateful to have this opportunity to talk about Seracap, and I do realize we're the last ones to present, so I'll try and keep it short and quick. Over the next 5 minutes-ish, I'll try and cover who we are, what really makes us different, and close out with our focus and approach in New Mexico. So starting with a quick background, Seracap Ventures is an early-stage venture capital firm founded in 2015 and investing primarily in 3 areas of technology: cybersecurity, enterprise AI, and healthcare tech. Let me take a second to talk about the relevance of these areas, some of which you've heard from our other GP colleagues today as well. While there is a lot of big tech focus on interconnectivity and almost the hyper-socialization of us as a species, we have significant fundamental issues like the $6 trillion lost to cyber theft last year alone and growing exponentially, our healthcare costs going through the roof, and as recent events have underscored, the constant battle for efficacy of healthcare systems in themselves. Hence, there's a very real need for technology to address these problems. And we believe that future growth, both economic and social, will center around these areas of cybersecurity, AI, and healthcare, and which are now rightfully being dubbed the new fundamentals of the digital age. And this is where Seracap has been focused on for years. Moving on to what's made us successful, first and foremost is the team. At the heart of Seracap Ventures are 5 of us partners. We each have diverse backgrounds, skills, and strengths, and most importantly, we've worked together for over 15 years. And there's the oft-repeated joke that, we still talk to each other. This team has been responsible for significant success in the past. Prior to forming Seracap, as Chris and Richard mentioned, we worked together at a large technology solutions and services company headquartered here, growing the organization from $20 million in revenue to over $1.5 billion in revenue, with 25,000 plus employees. The team was singularly responsible for driving revenue, growth, employment, and technology in over 10 countries. And this team has stayed together, grown together, and succeeded together over time. Second is our model and approach, which we've dubbed as the sales and scale model. And this really revolves around our definition of value as value-added investors. The value we provide our portfolio companies is encompassed in one word, which is revenue. Essentially, this means we invest in companies at an early stage and actually help drive revenue into them. While many people make introductions for their companies, we actually drive purchase orders. And we do this through our ecosystem of CIOs and CXOs of Fortune 500 and Global 1000 companies. And these are the deep relationships we've developed over our decades of work with them. And this real process of having that ability to drive revenue into early stage companies has been one of the key reasons for our success and creating the returns across our fund. And the third and final differentiator really is the proprietary deal flow we bring in each of our focus areas of cyber, AI, and healthcare, where we've developed a very deep ecosystem giving us access to key entrepreneurs and deals. In cyber, as an example, we work with several current and former intelligence agency talent in the U.S. and other key geographies, which has led us to invest in some of the most cutting-edge cybersecurity companies. In healthcare, we work with universities such as the University of Cambridge and research institutions across the U.S. In fact, one of our largest companies actually emanated right here from Los Alamos National Labs. And interestingly, several of our portfolio CEOs are highly successful serial entrepreneurs. So really, those for us are the key ingredients of the secret sauce, which is starting with the great team that's been tied to the hip for a decade, enhanced with long-standing relationships and the proprietary deal flow, and finally, just driving revenue and growth into these companies. And finally, to kind of close it out, I'll touch upon our approach with New Mexico. And as both Richard and Chris mentioned, we've had a brief but very deep involvement with the state thus far. We've already invested in several local companies here. We work with key labs, and as I mentioned, our largest company actually came out of research done at Los Alamos. And in the past 3 months, we've also helped one of our portfolio companies relocate its headquarters to the state, and it's been going well ever since. And this is all because we see that New Mexico has the key ingredients needed to foster that growth and entrepreneurship in an even larger way. With one of the key components for us being the presence of these labs and research institutions and the talent, with labs such as Los Alamos and Sandia, where we've seen cutting-edge research in cyber and healthcare. And really, we believe that they're all waiting for that right push to be commercialized. And that's where the opportunity lies for us at SERACAP moving forward, as a lot more can be done with global funds like us, with the reach and the understanding to take these local firms national and then global. And now in our next phase of this association with the state, we are planning to set up our offices in New Mexico and expand our ecosystem, and we've started discussions with folks at Sandia Labs, et cetera, as well, and work with the growing venture ecosystem here as well. With that, I do hope I'm within the committed time, and I've given you a brief overview of SERACAP, and I'll stop here for your reactions and questions. Thank you.
Thank you, Mr. Suri, and we're going to go to council questions at this time.
Yeah, Madam Chair, I did have one question. This is Lee.
Member Rawson.
I think I recall in the presentation that you're a minority-owned business, and I was trying to figure out what qualified you as a minority business.
Sure. And I'll actually redirect that to Richard and Chris because I know they ran the diligence on that piece. But if you look at the partners themselves, we're all first-generation immigrants here in the U.S. and qualify under the provisions that you have.
This is Richard Pugmire from Mercer. I mean, the criteria we look at with a minority-owned business, if it's 33% or more owned by minorities.
All right, thank you.
Thank you, Member Rawson. Further questions? All right, I think we're ready for a motion. Member Lavender.
Madam Chair, based on the recommendation of the Council Investment Committee, I have to get the right one. Sorry. Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $10 million, but not less than $5 million, to SERACAP 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender.
Second, Nick.
Okay, we've got a proper motion from Member Lavender and a second from Member Tejas. And any discussion on that motion?
Once again, Madam Chair, this was unanimously recommended for approval by the committee.
Thank you for reminding us of that. Any further discussion? All right, Andy, if you would call the roll on an investment into SERACAP 3, please.
Commissioner Garcia-Richard.
Yes.
Secretary Romero.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Mr. Jennings.
No.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes 6-2.
Thank you very much, and thank you to Mr. Suri and your colleague for being on from SERACAP.
Madam Chair,
yes.
very much.
Yes, thank you. So with that, we're going to move to our final voting item of this meeting. It's agenda item 3F. It is a review of our return target, and we're going to go to Mr. Smith.
Madam Chair, if I could just jump in for a second. We had a significant discussion about this at the council committee meeting, and we knew that there would be probably significant conversation at the SIC level, and we did unanimously recommend approval of 3F, but recognizing that there's probably going to be a significant amount of discussion.
Thank you, Member Lester.
Okay, well, thanks, Madam Chair, and I'll kick this off, or this topic off. This is Vince Smith speaking, Chief Investment Officer. I've just got a few, just get my notes. I've just got a few orientation and preparatory comments to make regarding this topic, and then we'll turn over to RVK to work you through the report and the specific recommendations for the vote. Hang on just a second, Madam Chair. Sorry, excuse me. You're going to be hearing about two different numbers today. First is the expected rate of return for each land grant and severance tax, and secondly, the targeted rate of return for each of those funds. Generally, these two numbers should be similar, but do not be the same. Just a second. I'm sorry.
Madam Chair, this is Steve. Could we please remind all of the folks on the call to mute their phones if they're not speaking? Thank you.
Okay, I'm sorry, I'm back. So the first number we'll be talking about today is our expected rate of return for each of the two portfolios, and then the target rate of return for each land grant and severance. These are two different numbers. The expected rate of return is primarily a function of each fund's asset allocation and RVK's capital market assumptions. You're very familiar with those assumptions. These are forecasts for the various asset classes that we use in constructing the asset allocations for each land and severance. RVK updates them annually, and we present them to you, the changes anyway, usually at your April meeting annually. The target rate of return is primarily a function of the distribution rate of the funds, the risk tolerance of policymakers like yourselves and the senior managers in the investment office, and the health of the funds as measured by the intergenerational equity model, as well as current macroeconomic and market conditions. Generally, we look for the expected rate of return and the target rate of return to be about the same. They don't have to be the same, but about the same. Generally, the expected rate of return will move around as RVK adjusts their market assumptions annually. The target rate of return, though, should be a fairly stable number. As you'll see when we get to the presentation in your book, the expected long run rate of return for the funds has materially fallen below the current target returns for each of those funds. This is primarily a function of the above average performance of the various investment markets over the last decade. Valuations have been pushed to very high levels relative to long-term history and thus have incrementally reduced future expectations of returns. You've seen this play out in RVK's annual assumptions updates back to about 2014. Generally, the expected rate of return and the target rate of return should be fairly close together, and when we get deviations like this, these types of mismatches should be addressed. So there's four basic things that we can do to address a mismatch when it occurs. The first is to do nothing. For small mismatches, that's the option we always take. Target rates of return for sovereign wealth funds like ours should be driven primarily by distribution policy, the general risk tolerance of policymakers, the health of the fund as in the intergenerational equity model, and secondarily by current market conditions. We've only adjusted the target rate of return twice in the past 10 or 11 years. We took it down in 2011 from a level we felt was overly optimistic, and again in 2015 with just a small change to land grant and severance. The second thing we can do is increase or lower, if the deviation is the other way, the risk of the portfolio to move the expected rate of return in the direction of the target. As RVK will show you today, that's not a particularly attractive option for us. In other words, increasing the risk of the portfolio to try to keep our expected rate of return close to 7 is not particularly attractive today. Third option is to lower the return target, which is what we're recommending today, to do a better job of reflecting current assumptions and realities. And, of course, fourth is just a combination of number 2 and number 3. We're not recommending this option today primarily due to the lack of attractiveness of option 2. So that's just a basic background. Look for 2 numbers today, the expected return and the target return. Expect those 2 numbers over time should be fairly close. They don't need to be the same, but fairly close. And then we'll recommend some actions to take to address today's mismatch. So with that, I'll turn it over to Matthias. Following that presentation, we'll both be available for questions.
Okay, great. Good morning, everyone, and thank you, Madam Chair, Vince, for those comments. This is Matthias Bauer with RVK, and I'll walk us through the target rate of return presentation that begins on page 391 of the materials. Vince did a great job providing some context and background in terms of why we're having this conversation today, and discussed it informally on a number of occasions in the past. And really the primary driver is the continued decline of expected future returns. Now, the return target, by and large, is used as a communication tool. Changing this number doesn't actually have any immediate impact on distributions or asset allocation or anything else. It's really just a communication tool to say, what does the fund, what does the SIC reasonably expect to earn out of the funds? And so while there's no direct or immediate linkage to any of these other components like the distribution rate or the distribution dollar amount or the asset allocation, we do think it's prudent to be realistic in the communication in terms of what stakeholders can expect from those funds over the long term. And it's not to say that they have to be one and the same year over year or year after year. But when there is a relatively persistent trend of change, that likely should be considered and reflected to the degree that there's some persistence that can be evidenced. So on page 392, we really highlight some of the things that Vince laid out in terms of what are some of the options when there are lower forward return projections. Those probably don't come as a surprise as we've looked at the capital market assumptions and asset allocation earlier this year. In the prior year, we saw a nice tick upward given some of the pandemic-related sell-offs that happened in March of the prior year, but then much of that was, and then some, has been regained since the onset of the pandemic, and that has resulted in expectations for the future not only to come down, but come down to a level that they hadn't been prior. So we've seen great returns out of the markets. Obviously, as you look at your performance report, or as Steve mentioned, the fiscal year return, tremendous double-digit numbers, but the flip side to that is lower forward expectations out of those markets. And so you do have a number of options, a number of choices to consider. Maintaining that target return certainly is one. I think the bigger risk is trying to stretch the amount of risk that you take in an attempt to get there, and we can talk about that in a little bit more detail. That's sort of one of the other scenarios that some plans choose to take because of the financial position that you're in. You're actually in a very strong financial position and don't necessarily have to make any suboptimal choices as a result. So there is no immediate cause for concern when actual investment returns are different than expectations or than historic norms, and we are expecting some mismatch going forward. But if it is persistent, then this is the type of conversation that's really quite timely. I mentioned that the strong position, and the Land Commissioner mentioned as well about all of the inflows that have been happening and exceeding expectations. That's really a very nice tailwind at present for the fund, and that helps support a higher distribution that may exceed what actually is expected out of the market, but that may not always persist as well. So I think it's helpful to keep those items in mind and recognize that if you are stretching perhaps on the return side of things, that could lead to a greater dependency on those contributions to make up any difference, and we see that in the intergenerational equity. Now, again, any change to your return target is not going to impact your intergenerational equity because that already reflects our expectations for the future, which is a return that is below the return target at present, as we'll look at in just a moment. So there is a mismatch, there is a difference on a forward basis, and that leads us to the question of should the council choose to lower the return targets for land grant and severance. They're a little bit different for the primary reason being some of the in-state exposure and severance tax. And if that's the case, by how much? So that's really the primary intention of this presentation, to help give you that background to hopefully make an informed decision as it relates to that. On page 393, we have some examples of other very large institutional investors in the nation, and the point being that you're not alone. Virtually every plan, every institutional investor that we talk to and that we're aware of is talking about this, is wrestling with the challenge of lower future expected returns, and pension funds in particular who are using that assumed rate of return or that return target to help establish a funding policy. It has a much more direct linkage there, and essentially are self-imposing higher costs on the plan as a result, but are doing so because they recognize there's really no way around that. And you can kick that can down the road for so long, but at some point, there's been a fair amount of litigation around that as well. There's really quite a bit of momentum to right-size those return expectations. So you can see 4 recent examples, all within the last 6 or 12 months, of very large funds that have brought their return expectations below 7%, some even below 6%, and lowered it anywhere from a quarter point to almost a whole percentage point. So these are tough decisions for these pension plans in particular. I think it's a little bit of an easier decision for sovereign wealth funds or perpetual funds because there isn't that direct linkage that I talked about. But I think it is absolutely helpful and critical to have the right communication tools to say, look, we're likely not going to continue to have the great returns that we've seen over the past decade plus going forward. On page 394 and 395, we're looking at the actual return that's been earned in the funds for land grant and for severance relative to the return target at those different points in time. This goes back about 2 decades to really give you a sense of what the actual experience has been. The blue line represents the actual return target over time, and Vince mentioned that it's changed about 2 times in the last decade or so, but you can see there it's changed a couple more times prior to that, and it was well above 8% at the beginning of the past decade. So, and that's not unusual. As we'll see when we look at peers and the broader trend, that they were quite high, and at some point that was quite reasonable. But over time, the momentum really is to shift these down. And you can see that in terms of the actual results being quite reasonable. So you have about 50% of the observations being 5-year returns on a quarterly basis, falling above the target at that respective point in time, and about half of the observations falling below. So it's been pretty accurate. Had it been at 8.5, for example, in perpetuity, those numbers likely would be very different. So there's been a thoughtful process historically to right-size those expectations as the market conditions have changed, and we don't anticipate, short of a very major change in the markets or tremendous sell-off, that will change for the long run because of where our valuations are really across most all asset classes. On page 395, same thing for severance, although again the return target recently has been a bit lower for severance compared to land grant, given again some of the in-state investments that just have a bit more uncertainty of outcome around the return expectation there. On page 396, this is the latest asset allocation modeling that we've done and provides the expectation of both of the two prime funds, land grant and severance tax. And here we have the compound number. Vince talked about the arithmetic and the compound being the lower of the two that incorporates the volatility risk there. And we know that volatility risk erodes wealth or return, and so that's the reason why you see that number being a bit lower. And the red number below each of the expected return figures is just the year-over-year change. So you can see that those big double-digit returns that we saw in the last year and a half, really took a big bite out of forward return expectations, anywhere from half to 3/4 of a percentage point. So pretty meaningful. The number that I like to look at most is the 10-year median expected return. So that's the risk-adjusted return over a forward 10-year horizon, and you can see that for land grant, that's about 6.2, and for severance, it's about 0.5% lower at 5.7. So well off of those current return targets that are shown at the top of those columns, 7% and 6 3/4 respectively. The two tables down below give us the probability of achieving certain levels of target return over the next 10 years. And in bold are the current target returns of 7% and 6 3/4, and we try to get pretty close to 50%. That's a fairly reasonable return expectation, and you can see that the current target returns are quite a ways off of that, more so for severance at 38%, 41% for land grant, and you really have to move up in that column closer towards the top to see numbers that start to approach 50%, probably 6.5 for land grants, or somewhere in there, 6 1/4, and 5 3/4 for severance tax. So it's a big change, but that's a reflection of where the market expectations are going forward for the next 10 or so years. On pages 397 and 398, we have the efficient frontier. Again, you've seen this from the asset allocation modeling, and goes back to one of the options that's presented that says, well, why don't we just change our asset allocation to something more high octane to give us more return? The problem with that is that you can see the lower of the two lines is that the line is quite flat. So by adding more risk, you're really not picking up any meaningful return. You're kind of already at that sort of sweet point where the slope starts to flatten materially. And sure, you could pick up a few extra basis points, but the amount of incremental risk that you'd have to take is quite a bit more, and likely not a good risk-return ratio offset. You could, and I looked at what would a portfolio, if you just said, look, let's throw a Hail Mary and see what we can get out of it. what would happen if you had only equity portfolio that was emerging markets heavy, global equity heavy, so call that 60% and 40% in private equity. So really putting it in a very concentrated portfolio of the highest returning asset classes or higher forward return expected asset classes. And even there, you're short. You're somewhere of 6 3/4, and that's assuming you could even get private equity scaled up to 40%, that you could have that kind of volatility, that kind of illiquidity, so on and so forth. Even then, the 7% or 6 3/4 is likely a long shot. So that's not a terribly viable solution either. And we wanted to make sure that was clear. So, and I would also say it's always somewhat suboptimal or suboptimal generally to try and optimize to a return target, because the whole point of mean variance optimization or asset allocation is to take the prevailing market conditions for all of the asset classes and find the optimal point, the one that gives you the most return for the level of risk. If you inverse that or flip it on its head and say, I need this return, then you're really not giving any acknowledgement to the amount of risk that you're taking. You're saying, I'm going to take whatever risk I need to take in order to get there, and that's just not in the best interest of the fund. On pages 399 and 400, a little bit more in terms of what is happening among peers. As I said, there's no plan that I know of that's not wrestling with this, that's talking about this and making hard decisions either this year, next year, certainly recognizing the need to right-size this. And again, I would say that a perpetual fund or a sovereign wealth fund has a lot easier time making this type of adjustment than a pension fund, where the cost is immediate and very real to making a change. In your case, it's not. But there you can see on page 399 that trend that I was talking about, top right-hand side in that graph, that the median return expectation is 7% now, and it's come down. It's come down fairly steadily for the last decade or so, and historically it was at 8%. But when the 10-year Treasury rate was higher, when equity valuations weren't as elevated as they are today, that was more reasonable. And lots of plans had that, and the expectations followed. But we're in a very different environment today. So you can see that return expectation falling both for the median and the average. You can see the return distribution down below. And again, this is as of earlier this year. There's lots of conversation, lots of notifications coming out from different plans that are making this decision at their meetings in these quarters, or have recently, or are going to make those changes. So I expect this distribution to change, but there you can see that it's pretty wide, and you don't really have a whole lot of plans that are even above 7.5, and most of them have reduced. 80% have already reduced at least once their expectations since 2017. On page 400, this is the black dot peer comparison, and the black dot is a peer group that we've used extensively in the past, primarily for asset allocation purposes, and that's a reflection of not just funds that are similar in size and resources and capabilities, but also that either have geographical proximity or other similarities that could be meaningful or useful to the SIC. And the point of this page is that the story is the same. Even when you say, well, look, pension funds maybe don't apply to us, at a more tailored peer group, the same is true. We also wanted to look, this is down below, if the health of a fund, measured as the funded status, if that somehow informs whether a plan chooses to select a higher or lower return expectation, and that's not exactly the case. You have some that are in really poor shape, that have high return expectations, which in some cases makes sense because they are essentially going all in with their chips because they are in such bad shape, or conversely, they're saying, look, we need to preserve all the capital that we have. We need to maximize liquidity and essentially be on a defunding path and have a lower expectation and perhaps a very conservative portfolio as a result. But it's fairly dispersed, so it's more a byproduct of, I think, a willingness to acknowledge the market conditions. But the trends are clear that the universe broadly is moving down, just at perhaps different speeds from one plan to the next. So there are some implications and challenges that Vince mentioned that I alluded to, and we've tried to articulate those on pages 401 and 402. Ultimately, asset allocation is the driver of all the returns. We talked about that. It's most impactful in terms of the return experience, and that's developed in the context of the investment policy, which includes investment objectives, the guidelines, the direction provided by the council, fiduciaries, and that's absolutely paramount. But all of that is driven by essentially the prevailing market conditions and the valuation. So we are only going to get the returns that the markets will offer us, and so we have to try and align those as much as we possibly can. There is, of course, the temptation to, again, say, does it make sense to take on more risk? It's certainly an option. The timing isn't great there, and likely will ultimately just result in more volatility of the return experience. And I think even though contributions have been very strong and distributions have been at record levels as a result, that may not always be the case. So I think having some level of prudence there makes a good deal of sense. The ultimate recommendation here, in light of all of this, is listed on page 403, which would be that the council consider a reduction to the return target, both for land grant and severance, to bring it more in line with the long-term return expectation for the funds. I think it's a pretty reasonable and attainable number, and hopefully is more in line with what markets will likely give us over the next decade plus. So you can see for land grant, that would be a 50 basis point or 0.5% reduction to 6.5, a larger reduction for severance tax, primarily driven by the increasing weight of the New Mexico in-state investments that just have lower certainty of outcomes, as I mentioned before. And as a result, the return expectation there could certainly surprise on the upside, but I think there's a level of conservatism that's built in here at present that probably makes some sense until those programs have a longer track record. So appreciate the time and happy to take any questions or comments. Do my best to answer them.
Thank you to Matthias and Vince for that very comprehensive report on this recommendation for the council to consider today. So I'm going to turn it over to council members for questions.
Madam Chair, this is John Bingaman.
Okay, we'll start with Member Bingaman. Thank you.
Question either for Vince or Matthias, but just looking at page 400 and the black dot analysis. So if I understand the recommendation, you're suggesting that we should take land grant pretty much to the bottom of all the peers, tied with a couple of others, and I guess there's that one outlier way at the bottom there. But out of 30 peers, we would be one of 3 that was down at 6.5% for our return expectation. And then I know, when we look at that black dot analysis you do on the quartiles, I think, in terms of risk-adjusted return, we are generally in the top quartile. Like, how do you help us sort of reconcile those two things? Generally, I think we've outperformed the peers in that respect, but we're anticipating lower returns than all the rest of the peers. Are our assumptions just more conservative, or how should we think about that?
Well, I'll throw on first here. This is Vince Smith, Chief Investment Officer. I think, most of our peers are pension funds, and they tend to change their returns more slowly. It has big impacts for them, their assumed rate of return on their unfunded liability. So that group's probably slow. We tend to be a little faster. As a sovereign wealth fund, we can be a little bit faster. So I think that's part of the solution. And all those returns that you see there have been run through RVK's return assumptions. So we're all on equal footing in terms of future expected returns. So I think, John, we're just in front or toward the front in getting returns down to what we're seeing, is probable in future markets. I don't know, Matthias, is there something else?
No, I think that's right, and I think that's fairly consistent with my observations and conversations with other pension plans as well. I think to John's point, I think you have some of the best risk-adjusted return expectations going forward, but that doesn't mean that there's still not a shortfall to the return target. I think it's just smaller than it is for a lot of the other funds. I think they are absolutely slower. Some even recognize the need to do it, but say, look, we just can't afford it, or we recognize that a lower return target would be prudent, but the immediate cost in the pension world might be too great to consider this now, and let's revisit it in a year or two. Those are very real conversations that are happening. Again, I think in your position, being that your funded status is essentially 100%. You do have intergenerational equity considerations, but overall don't have explicit liabilities or a normal cost that's tied to the discount rate. You can change it to 5%, and it's not going to change the distribution amount immediately or the funded status that has to be reported through the CAFR. So I think you have a lot more flexibility, and as a result, probably have a smaller gap and are able to act more quickly. But I can assure you that none of the other public pension trustees wouldn't want to make this change if it didn't have a much larger ramification. And it's not they're not doing it, because of course they have a fiduciary duty to right-size this number, but they do have to manage that within budgetary constraints and other things, so it can just take longer.
Okay, thank you for that. And if I could, Madam Chair, with another question.
Please.
On the difference between the land grant and the severance tax, you're moving the severance tax down a full 100 basis points. That'll be 75 basis points, I guess, below the land grant. And, looking historically, I looked at some of the reports going back 10 years. I think the delta between those two funds in terms of annual returns have been quite a bit smaller than that. And so my question is, how much of this is factoring in, some of the, what I consider relatively short-term economic development efforts around some of the loan programs that came out of the legislature that, I think we all expect that money is going to be available again soon to be redeployed in higher return areas. And my concern is, are we penalizing ourselves in terms of expected return on the severance tax too much for something that, is relatively short term in terms of the allocation of those specific programs that are going to roll off, relatively soon?
Well, I think that's a real good point. Madam Chair, this is Vince Smith speaking. I think that's a real good point. I think we're doing a better job now of breaking apart the private equity program that's in severance tax, so the allocations to national and in-state. So I think that's part of it from a more structural view. So that distribution, I don't know, reverts back to the old distribution, which was primarily the national program, the higher returning national program in severance tax. I think we're much closer to a 50-50 on a structural basis going forward. So that's part of it. But I do see your point about if these programs roll off faster than, the long-term potentially that rate of return is a little bit higher. We'll have to look into that. I appreciate you pointing that out. Matthias?
Yeah, I don't have much to add there. I think you're right. Historically, it's been pretty close in terms of actual return. Given that, I would say the in-state investments have grown to a more significant allocation only in the recent years, but also I think our approach or sophistication to modeling and taking a more bifurcated approach to the expectation. Historically, we didn't really break out the in-state because it was a smaller allocation. Just sort of said, okay, this may be a little bit of a drag on performance relative to the national program, but it's pretty small, so it's probably okay. And as it's grown in size, I think the approach has just been a little bit finer to that. But yeah, I echo Vince's comments. If either the program doesn't continue to grow in size like it has, or perhaps rolls off quicker, or perhaps surprises on the upside in terms of return expectations, then that spread could certainly compress over time.
Yeah, thanks for that. And I guess just make a comment. I mean, I understand and appreciate all the work and analysis, and I think from my perspective, it would make sense to sort of stand pat at this time and just continue to see things play out maybe for another year. On that question in particular, I just don't want us to be using a snapshot in time to sort of set a long-term return expectation, and maybe I just don't understand the numbers well enough, but that's kind of where I'm at the moment.
Madam Chair, Lee, I have a question.
Go ahead, Senator.
Given the previous discussion, I might have missed it in there, but what is ERA's and PERA's current return projections?
Madam Chair, this is Vince Smith speaking. Member Austin, I believe ERB's at 7.25. I think PERA is effectively there. They've got a short run expectation of 7%, and so for years 1 through 10, their expectation 7%. Years 11 through infinity, I guess you would call it, is 7.5. So they blend those into about a 7.25 expectation.
Okay, thank you.
This is Jennings. I just wondered if I heard everything right the way I did. You're expecting that the rate of returns will appear less than all our peer group. And all I'm going to say is how are we going to use that to structure in the legislature with telling everybody that we need more money for staff, and they're all going to come back and say, well, you're making less money than your peer group. Did I hear all that right?
The return expectation is particularly on a risk-adjusted basis, is actually at the top of the peer group on a go-forward basis. So we would anticipate that returns relative to peers are going to continue to improve, short of a major change in the environment, and of course we would follow up with likely a change to the asset allocation strategy. But at present, no, I think you're well positioned to perform just as good as peers or better. I think this is really a change to the return target, saying yes, we recognize that even if we return at the top of the heap, those returns across the board, given the market conditions and market environment that we're in now and in the foreseeable future, is likely going to be below 7%. Yet, if we have a return target of 7%, we're essentially communicating to the public and to stakeholders that we think 7% is a realistic number for the next decade plus, and that may very well not be the case.
Yeah, I think we're talking the difference between actual returns and future expected returns. We consistently outperform that group that you're looking at that in that chart in the broad group, where we're consistently in the second quartile, and we expect that to continue just based on our positioning, as Matthias was mentioning. We just think we have a less optimistic outlook on what's coming down the pike than our peers do. I think that's all that represents.
Okay.
And Madam Chair, this is Nick.
Number 10.
Yeah, my question really just revolves on why we're not comparing our sovereign wealth fund to other sovereign wealth funds. We're trying to make comparisons to pension plans, and just wanted to hear some comments on that. Why didn't we get some comps with what other sovereign wealth funds are doing?
Madam Chair, this is Vince Smith speaking. There's just relatively few, comparable sovereign wealth funds. The vast majority of our peers are pension funds. In that black dot chart that Matthias was showing you is inclusive of the Alaska Permanent Fund and the Texas Treasury, or the Texas Permanent Fund. I don't think we have Texas Treasury in there yet. So that's two Alaska Permanent funds. Both of those funds, I guess, are larger than us. Alaska Permanent Fund's the largest. So those two compares are in there. But outside of those funds, there's just relatively few sovereign wealth funds, and often they have different investment objectives. So they have materially different asset allocations than we do. So their expectations and their outcomes, will be different than ours. The process of putting together a pension portfolio, and I did it for 20 years, is quite similar to putting together a sovereign wealth portfolio. We use the same asset classes. We use many of the same managers. So there's a lot of similarities in managing the money. Different objectives, of course. The pensions are obviously trying to fund future benefits, and we're funding future distributions, but based on a set formula. But the investment management is reasonably similar. So the compares aren't terrible. They're not perfect, as if we could have 50 Alaska Permanent funds to compare to, but they're not terrible, based on them being pension funds.
And were you all able to look at the asset allocation in comparison to ours? Were those sort of were you able to get into the details to that extent, where we looked at how those comparative funds are allocating their assets and compare that to how we handle ours?
Yes, very, very much so. So when we put together that black dot chart, we drill right down into the sub-asset class level, actually. So we look past just the general asset class to see how they're actually structured, and then try to come up with, a return and risk assumption for something that's pretty close to what they actually have in place. So we drill down pretty deep when we're doing that analysis.
Okay, thank you. And then if we could turn to page 394, I'm looking at the Land Grant Permanent Fund rolling 5-year actual. This is a really interesting chart of information here. With the blue line, that return target, was that the policy, the historical sort of policy implemented return target for the Land Grant Permanent Fund?
Matthias, you want to take off on this one?
Yeah, it was not the policy implementation, but it was the return expectation at that time. And As we mentioned, the return expectation or actual return is going to move up and down around that. But you can see that the most recent flat line is the 7%. So that's the current level, and then down in the footnotes we have the actual levels and the time periods of when the funds had adopted different levels in time. So historically, 8% that it moved up to 8.5 from 2003 to 2011, and again that's just sort of same as the 7% today. What the council put out in terms of what it thought it can earn out of the markets. Now, whether that actually tied out to the asset allocation may not always be the case, although, as Vince said, at least for the last decade or so, we've tried to keep an eye on making sure that the arithmetic and the compound return is straddling that number as best as possible, and only when we see bigger deviations from that is when adjustments are being considered and proposed. But it's not to imply that, for example, from 2003 to 2011, 8.5% is necessarily what the asset allocation model would have put out. And you can see the actual returns in green were all over the place, above that, below that, but over sort of the long run kind of averaged out to that. And we don't anticipate that to change meaningfully, although you'll see, and you see that on your peer ranking percentiles, how historically you're sort of best or worst. You can see that on this line here as well. The green line is up or all the way down. It was sort of all or nothing. And then the last decade or so, on the right-hand side of that chart, you can see that green line is a lot smoother. It oscillates a lot less than it has in the past. And we hope that is going to continue. That's certainly our intention and our goal. But we do think that the green line is going to likely trend down on a rolling basis, just given the market conditions and the valuations. And so as a result of that, even though the spread is tighter to the blue line, which is great, we think that the trajectory might likely be going downward. Is that helpful?
It does help, but if you included the geometric mean on this chart, what would that look like? What would the line look like? Would it be
the expected geometric return at each point in time?
The actual.
Yeah, I mean the 5-year rolling return includes essentially is a geometric. It's not an average number. It includes the volatility. So I suppose you could make an argument that the green line is that number.
I thought the green line was it's the 5-year rolling average. I thought it was the actual.
It is, but that's what you ultimately the risk adjusted or the compound return is ultimately what you end up getting. The average is more on any given annual basis, but not when you're looking at actual returns. So I think that's as close to a representation as we'll probably find here.
Hmm. Yeah, and the other thing that stands out to me really is that the quarters above the target were 56%, and what are we expecting? Let's just say in the next 10 years, would we expect that the quarters stay above the target at that same rate, at 56%, or how do you look at that?
Yeah, we can see that on page 396, where on the bottom left, so assuming that the return target, the blue line, stayed at the 7%, we would expect that only 41% of the time would we get to that 7%. So if there wasn't a change, we would likely anticipate that percentage of quarters above target would decrease over the next 10 years, and very likely cross the 50% threshold there. So, it is somewhat, I think if you look at that chart, most of those observations likely are at the beginning of the period, so from 93 to probably 2000, when the returns were really quite strong in that market environment. But more recently, have been certainly more in line with the return target, and that's the expectation. But then prior to that, you can see that you've had a number of quarters that were below. So if you were to run this, over maybe 2000 onward, those percentages would likely not be as close to 50-50 as you see here. So, but this is, I think, a full up and down cycle. I think it's encouraging that you're closer to the blue line. You don't have these big deviations anymore, but we do still think that those forward returns, which return into actual returns, are going to be trending downward.
Okay, Madam Chair, I'm just not seeing how we get to, and I know that there's a esoteric calculation on how we get to the idea that we would achieve 7% 41% of the time, but then when you look back at the last 30 years, it's completely different for me in terms of how I look at that chart. So I kind of have the same view as Member Bingaman on, we may need to sort of take some time to really study this and look at whether or not this is the right time to do this. Can you, maybe Vince, if you could let me know, when was the last time we kind of re-upped this or recalculated our target? When did the council do that the last time?
We annually update you on the expected rate of return, so what we think we'll make based on RBK's assumptions and our current asset allocation. We monitor that number versus the target. The last time we adjusted the target was 2015. That was after the big market run out of 2010 through 2014. Valuations got very high. RBK's assumptions were coming down pretty hard in kind of 14 and 15. So in 15, we reduced the target by 50 basis points. Previous to that was 2011. It was 8.5 when Steve and I came in, which was a stretch. And so we reduced it to 7.5 from 8.5 there in 2011.
Okay, thank you. That's all I have.
Madam Chair, it's Harold. Along those same lines, I realize it's probably make-believe, but if the next 10 years look like the last 10 years, if we make these changes, how might that affect how much money how well we do? I hope I've asked that question intelligently, because it seems to me that I made this comment at the investment committee meeting. If you look at the last 10 years, the returns have been well above the 7% and the 6.75. And I'm just curious, if we make these changes, how might that affect our rate of return over the next 10 years if things stay wonderful?
Well, the change in the target has no influence over what the portfolio actually earns. So the things that matter in terms of what we actually earn is our asset allocation, and then the general returns from those asset classes over, say, the 10-year period that you're talking about. Our return target is divorced from that. It's got no impact on what we actually earn. The return target is just an expression of what we think we'll earn based on what we think markets will do going forward. So the only relationship between the past returns that we've gotten and the future returns we expect is that the better the returns were in the past, there's a higher likelihood there'll be less going forward. mainly because high returns, above average returns, generally push market valuations up, which need to be corrected back down to more normal valuations, which generally means lower returns. So high previous returns are often, correlated with lower future returns. And I think that logic is what you see in us, recommending we lower our return target based on the future expected lower rates of return.
Thanks.
So I'm wondering if there's anyone else. We've had a request or a suggestion by Member Tejas to postpone the vote on this particular item at this time. Is there other desire from the council to do that?
Madam Chair, it's Harold. I think that based on the conversation today, and which I think we tended to anticipate, what if we were to table this to a future time? And the question I would have is it imperative that we approve this now or disapprove it, depending on the vote, or would it make sense to possibly punt this down the road a little bit for further discussion and consideration?
I would say, if I can put in, Madam Chair, I would say if you want to defer a decision on this, I would defer it till next spring. RBK will be coming out with their new capital market assumptions. I don't anticipate any recommendations for changes to the asset allocation, so that'll be the only moving part, really. And we could take another look in the spring with their new assumptions and see what the spread is between the 7% and what we think we can earn, with the portfolio based on those new assumptions. So if you want to put it down the road, and there's no urgency or immediacy here, it's just so we've got a pretty big gap between what our models are telling us we can earn and what we're expressing that we're targeting. That's what's driven this recommendation. If you want to wait till the spring and when we have fresher assumptions, that's perfectly fine from my perspective.
Okay. Thank you, Vince. Is there any objection to doing that?
This Lee, I have a question.
Yes, Member Rawson.
Vince, could you remind me when the last time we revised our estimate was?
So we revise expected returns on the portfolio annually with RBK's annual change in their assumptions, usually in the spring. We usually bring it to your April meeting. Occasionally, if we make an asset allocation change, we study that once every 3 years, and if we make a big enough change, we'll review our expected rate of return then. In terms of the targeted rate of return, that's just something we monitor, and when the difference between our future expectations and that number get pretty wide like it is now, that's when we come with a recommendation. And that last happened in 2015 and 2011 before that.
Okay, thank you. I would just be in favor, I think, of going ahead and doing it now, because it's not really going to reflect any investment changes. Thank you.
So I guess what I'm asking is there anyone that objects to postponing it? So I'm not sure who's the best person to answer this question. I don't know if Evan or Bruce is on, or Steve. Do we need a tabling motion?
I think it's probably wise. Let's do that.
Madam Chair, I'll go ahead and do it. I move we table this issue until the April meeting in accordance with what Vince just discussed, and have a chance to have a lot more time to review this.
This is Kathy Allen. I second that.
All right. So with the tabling motion, ladies and gentlemen, if you vote yes to table, that means we will take this up in April if the vote carries. If you vote no to table, then you'd like to take it up now. So we're not actually voting on passage of this item. We're only voting on a motion to table it. Is there any discussion on that motion? Could I get Andy to call the roll on a tabling motion?
Commissioner Garcia Richard.
Yes.
Secretary Romero. Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Sorry, yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion to table until the April meeting is passed.
Madam Chair, this is Tim Eichenberg, and I vote yes as well.
Oh, I apologize, Mr. Treasurer. We did not know you had returned.
Yes, ma'am. I enjoyed the conversation, though, so thank you.
Okay. Andy, would you note Mr. Treasurer's vote, please?
Yes, thank you.
Okay, very good. So the motion to table has passed, so we are going to take this up at a spring meeting. I believe it was recommended for April, and I don't think we need to do anything more on that item, so we will move now to the CFO report. This is agenda item 4A for those following along at home. Mr. Schiff.
Madam Chair, I'll be really brief, probably less than 2 minutes. I'm on page 410 of the material. I just wanted to point out under item number 4 that the exit conference for the fiscal year 21 audit, the audit that we're undergoing right now, is scheduled for November 16th of 2021. If there's anybody on the council that is not involved with the audit committee that's wanting to be involved with that exit conference, please let me know ahead of time, and I'll make sure that you get all the material. And then I'm flipping over to page 417, and I just wanted to point out, everybody probably, this is the index for the investment holdings report. I just wanted to point out at the bottom of that index, you'll note the reason for the report being so thick at the end of September. This is the end of a quarter. So you'll note starting at page 12 through, I guess it's page 36, you have calculations of monthly changes, which rolls forward the pulls from the beginning of the month to the ending of the month. And you also have the same thing for the quarter. Just realize that for the quarter, your starting values are going to be different than they would otherwise. And I wanted to point that out because I've gotten some questions offline about that, and I want to make sure everybody understands. And then the only last thing that I have relates to page, I guess it's 481. I just wanted to point out, as I always do, and I think the land commissioners already pointed this out, the contribution for this month of September coming in on the investment holdings report from the land office was $125 million. I think I went back, and that was at the time an all-time high. I don't think I've seen a number higher than that, and everybody should just be apprised that, as the land commissioner said earlier in the call, we're to expect an even bigger number coming in October. So we're really looking forward to that. Other than that, that's all I had, unless there was questions.
Thank you, Mr. Shipp. Questions from council?
Madam Chair, this is Lee Rawson.
Member Rawson.
I'm curious if Brett has a guesstimate at this point of what our net cash flow average is over the past 12 months, given the inflows and the outflows and the distributions with the various investments on just the land grant and the severance tax, not the minor funds.
Member Rawson, I don't have that on hand right now, but I can easily compile something to show. Certainly for the land grant permanent fund, the inflows coming in are almost, I shouldn't say almost. They can almost cover the distribution. So that's a good position to be in. We've had situations where the inflows are a lot less than the outflows as it relates to the land grant contributions. On the severance tax, it's a different story. I mean, we don't have near the inflows there that we do on the land grant. So it kind of flips on that. But the outflows, I should point out, are a lot less than you would have in the land grant permanent fund. But if you want more detail than that, I'm happy to provide that, Member Rossin.
Well, I would like to get a little bit more detail because it kind of goes into, in my mind, a little bit of the general election issue coming up next year, as well as we do have changes in our investments, that are happening, throughout time too. So I just would like to see what that cash flow looks like, the net one. Thank you.
Okay. I will get something together and get it out to everybody.
Thank you, Member Rossin. Further questions for Brent? All right. Thank you very much, sir. We're going to move on to our closing matters. Agenda item 5A, any old or new business before the council today? All right. Just a reminder to folks, our next SIC meeting is going to be Tuesday, November 23rd. I believe will be conducted telephonically. And with that, we're going to go to public comment. That's agenda item 6. And ask Charlie, Mr. Woolman, if there is any public comment that's been submitted for the record.
Madam Chair, we did not receive any public comment for this meeting today.
Okay. I'll take a motion to adjourn.
This is Harold. So move.
All right. We've got a motion from Mr. Lavender to adjourn. I never know if we need a roll call vote on an adjourning motion, so I'm just going to ask for a second.
Second, Nick.
All right, and ask if there's any opposition to adjourning. All right, with that, we are adjourned.